Our next panel, The Current and Future State of Behavioral M&A, is beginning now, featuring Tony Munoz, Christopher Dooney, Alan Schabes, Bede Broome, and Anton Kuznetsov.
It's close. Close.
Great. Thank you so much for joining us on this panel today, and thank you to these gentlemen joining me. My name is Tony Munoz. I'm a managing director and lead healthcare services investment banking for a firm called Cantor Fitzgerald. Cantor Fitzgerald is a middle market investment bank, full service. We've been very active in healthcare over the last couple of years and extremely active in the behavioral across all different verticals of behavioral, outpatient, ABA, inpatient, and substance abuse. Again, our discussion today is really to give you the current state of the behavioral M&A market. And I'll have each one of these gentlemen introduce themselves, their backgrounds, and experience in the market. So, Bede, why don't you kick us off?
Thank you. Good morning, everybody. So, Bede Broome. I'm a managing director with Assured Healthcare Partners. We're a private equity fund based in New York. We have about $1.5 billion under management. We focus only in healthcare, and within healthcare, only in healthcare services. We have about 11 portfolio companies right now across a variety of different spaces. In behavioral health in particular, we have two assets. Promises Behavioral Health, which is a largely residential SUD and MH treatment program with facilities in Massachusetts, Pennsylvania, Tennessee, Florida, Texas, throughout the country, and rapidly expanding that. And in addition to that, we have a great program called Athena Care, which is based in Tennessee. That's outpatient psychiatry primarily. We have a variety of other healthcare assets. We have a number of different physician platforms. We've been heavily invested in the SNF space in the past. We've owned hospital systems, although we don't own any right now, and a variety of other health service tech companies.
Alan?
Good morning. I'm Alan Schabes. I'm a partner with the law firm of Benesch Friedlander. Benesch Friedlander is a national law firm, and we have a very large healthcare and national healthcare practice, which I co-founded and formerly led. In the behavioral space, we have actually been involved in the behavioral space for more than 20 years. And it's really covered the gamut of behavioral health all the way from inpatient psych, outpatient, IDD, drug detox, eating disorders, and now spending a lot of time in ABA and autism. I'm a transactional regulatory and compliance lawyer, so I get to see all of the facets of what's going on. And I'm delighted to share my thoughts with you today. Thanks.
Good morning. I'm the CEO of Kolmac. We're an outpatient addiction treatment business. We're based in the Mid-Atlantic. We have about 16 locations across 5 states. We provide a variety of services, starting with virtual detox. We're actually one of the few companies in the United States that do virtual detox. We step patients down to IOP, and then we step them down to OP and aftercare. We also have an OTP business. That's our methadone clinics as well. Besides providing the addiction treatment services, we wrap around mental health services. We wrap around some aspects of primary care, and we have a population health management service as well. So we really consider what we do truly integrated behavioral health, and that's in our name.
Great. Hey, I'm Chris Dooney. I'm a Senior Director in Corporate Development at UHS, also known as Universal Health Services and not United Healthcare. Often people confuse that. UHS is a provider of behavioral healthcare services with 330 sites across the United Kingdom, United States, and Puerto Rico. We also manage 28 acute care hospitals as well in 7 states. Traditionally, our platform was more inpatient psychiatric care, but as the last number of years, we're diversifying into a full continuum of care.
So for you all, you're getting the perspective of a private equity firm, an investor, a lawyer, and then 2 operators. Anton, why don't you talk about your business? How have you used M&A to execute on the company's growth strategy?
Yeah, so for us, it's mainly been tuck-ins. We're not looking at any transformative M&A type of deals. For us, we're focused on tuck-in acquisitions in markets where we want to expand, in markets where we already have a presence and we just want to build more density, whether it be acquiring a license or getting a foothold in an adjacent market. So we've been opportunistic buyers in these markets. We're not aggressively pursuing deals at this point in time. We're pursuing a organic strategy right now, but we're always looking at acquisitions that make sense, that fit within our market, that fit within our evidence-based model, and where it makes sense for us to expand.
Got it. Chris, what about you?
You know, we're really approaching a no wrong door approach with our acquisition strategy. So will we acquire more hospitals? Sure. Opportunistically, if they're in the right markets with the right dynamics. But I believe some of you all heard my colleague Shaban yesterday. I think you know, filling in the gaps of care is very important for us. We have a mission and a vision to get into value-based healthcare quickly. We are one of probably a handful of folks that probably can execute that in the behavioral health world. So very excited to look at opportunities that accelerate that for us.
And Bede, from the private equity side, from Assured, are you looking at both tuck-ins like Anton? Are you looking at for big platforms?
Both and everything in between. You know, it depends on the situation. For our larger platform promises, we might be looking for both transformative larger acquisitions in addition to tuck-ins. For AthenaCare, we have the CEO of AthenaCare here. Again, I would say the same. In some cases, we'd be looking for larger transformative transactions or tuck-ins or even acqui-hires.
Got it. Got it. Hey, Alan, let's talk about the current state of the behavioral M&A market. Sure. What are you seeing, you know, from your perspective?
So I think you got to divide it up into the various sectors and the various segments. Let's start with the most sort of intensive, capital-intensive side of the market, which is the inpatient psych, hospitals. There's definitely a significant amount of activity that is out there, and those that are available are a very competitive situation in terms of pricing. But there are other people in the sector that are really doing it in a different way, that are looking to joint venture with existing hospital systems, to repurpose assets that those hospital systems have that are no longer productive, and they're doing it in a collaborative and kind of a joint venture way. So we're seeing a lot of activity in the inpatient psych area in that particular segment. As it relates to kind of further down the scale when it comes to outpatient mental health, we're seeing a lot of interest in the area, but it's hard to find companies of scale that will make a difference in terms of a platform. And the experience that we have seen is that it's at times hard to find a really good management team that has a vision and a focus and an expertise in the area that really makes it worthwhile to have a transformative M&A transaction. If you move further down the line, which is the drug detox, and let's just call it the addiction center, which of course is an overly broad characterization because there's all kinds of variations within that. We're seeing very robust, but combined with a robust M&A market, we're also seeing a degree of kind of a separation of value between the sellers and the buyers, because in drug detox and addiction centers, there's really no barriers to entry, as there is, for example, in the inpatient psych hospitals, where depending on the states that you're in, you could very likely have to go through a regulatory process like a certificate of need process, and you can't just build one out of the sky, where if you want to have a drug detox center, in most cases, you can do that pretty easily. So there's really not a significant barrier to entry. But we're seeing that obviously with all of the money that is flowing into the sector, there's a huge amount of interest. But again, what we're seeing are our clients having a little bit of a struggle finding platforms that are well organized, well run, have really good management teams, And when they do find those particular sectors, again, the interest in those particular types of companies are very, very robust and very much very competitive. And then when you move further down the line to the autism area, which is like, at this point is like the wild, wild west, because it seems like there are ABA companies that are forming all over the place. There are very, very few ABA companies that are out there. Some of them are here today, but of any size and platform, and those certainly have garnered a great deal of interest in the M&A market. But there's a very, very significant consolidation play that is out there for those people who have those platforms in order to consolidate the market because of the proliferation of ABA providers that is out there today.
Yep, got it. Hey, Chris, what are your thoughts on the state of the market today? Threats, opportunities?
Yeah, we're definitely open for business. I know a lot of people have put that close sign up. Opportunities, I think strategic buyers need to capitalize on this moment. I think valuations have plateaued, and it probably may not fall much further than this. And so, I think that's a huge opportunity for strategics. I think I see a lot of deals come through, and when you pass on a deal, you always got to wait, 6 months for the Wall Street Journal to announce the deal. I'm not seeing anybody announce these deals, and so they're stalled processes. And I've said a number of people. I think the pull out of the market, reinvest in your business, and grow is often a strategy for portfolio companies, and that works to an extent. But if you grow too big, there's not many people that can acquire $1 billion entity. Right. That's not even easy for UHS, and so I think that's a risk right now.
Bede, what about you?
Yeah, I definitely echo your point around seeing a lot of stalled and broken processes. I think the great assets are still coming to market, and there will always be a market for great assets. But kind of what defines a great asset today is different from what it was mid-2022. It's not just enough to have rapidly assembled a platform and sort of rapidly assembled a team and sort of just bring that to market. Now, we are certainly looking for more established track record, deeper team, real integration between assets that are coming to market, in addition to obviously a very good strategic fit with either our existing assets or unique capabilities that entrench those assets in the markets that they serve. The macro trends are all still there, and that continues to excite us, and I see nodding heads. I think it should excite everyone. Like, there is tremendous need for mental health treatment in its various different forms, behavioral health treatment in its various different forms, and I think that reimbursement is also is there and is improving and is catching up. Market by market, there are differences, but so that macro certainly exists. We're hopeful that the overall economic climate improves somewhat and makes some transactions easier, but yeah, it's been a mixed bag for the last 6 months.
Yeah. Hey, Anton, meeting with a couple of folks this week, they were excited about recessions. Recession is good for their business. Well, what are your views about macro factors, recession, debt ceilings? How does that impact your business? And again, are you playing offense or defense in an environment like that?
I think recessions are good for us from a labor standpoint. I think a lot of folks in this room are feeling the pain of wage inflation, of the difficulty of finding staff. I think that will correct itself. We're already starting to see it correct itself somewhat. Most major companies are announcing layoffs, whether it's in tech or whether it's some of these telehealth platforms. So I think that will be good from a labor standpoint. I agree with Bede that all the macroeconomics are still there. I mean, every day you turn on the news, the drugs are only getting stronger. First it was fentanyl, now it's tranq. Who knows what it's going to be next week or the week after that. So there's definitely a lot of need for services. I don't think that ever goes away. Yeah. The one thing that concerns me is stupid legislation. There's a bill that can affect my industry pretty greatly right now that's in front of Congress. It would basically allow any pharmacy or any doctor to prescribe methadone, Right now, only a licensed OTP can prescribe methadone, so we're regulated by the DEA. We have a safe, we have a whole process. I don't think it's going to pass without some major, changes to it. But it's legislation like that where people are overzealous of fixing a problem without really understanding the problem in its entirety. And they're proposing these kind of blanket solutions and getting support around it. So that to me would be the only threat. We've had some really positive tailwinds from a legislative standpoint. There's always been support for the addiction treatment industry and for the mental health industry. So I just hope that continues.
Yep, yep. Hey, Chris, on the technology side, you didn't bring that up. Are you looking at teletherapy as UHS? Is that a requirement for an acquisition?
Yeah, no, we've brought on FTEs to work in that area. I think even on the acquisition front, we're looking at those opportunities. I think valuations around digital health, don't necessarily track with healthcare services. So sometimes it's challenging to kind of get in that arena when we're a predominant services company. But we have conversations every day about how to make strategic investments in some of these assets where we can get our foothold in and allow them to essentially have the keys to the kingdom on laying their platform out. So it's been we've had some good conversations around that.
Yep, yep. Hey, Alan, talk to us about a recent transaction. What are lessons learned from some of the recent deals you've done in this space?
Yeah, let me talk to you about a recent transaction in the ABA space. And then I'll talk another transaction in medical assisted treatment space. On the ABA space, the biggest issues that we came up with at the time was really assessing the Q of E, assessing the quality of the earnings that are there, and appreciating the difference between in-network as it related to ABA versus out-of-network. Because even though those ABA companies that were out-of-network, they were showing, and the target that we had there had in-network and they had out-of-network. But the out-of-network was far more lucrative than the in-network, and they had these single case agreements that were extraordinarily lucrative. So when you had the EBITDA that was there, about 60% of the EBITDA was out of network and 40% of the EBITDA was in network, which was interesting. But what we found as we did the due diligence is that the payers were becoming increasingly hostile to the out-of-network ABA environment, even though they had entered into these single-case environments. What we had seen anecdotally, but it also, as we did the due diligence, it really affected the target there, is that the payers were beginning to impose prepayment reviews, and sometimes they were actually just throwing the ABA, this particular target, off of panels because they were spending too much money on this. So assessing that particular area was definitely something that was unique to that particular area, and it was a big obstacle to getting the deal done so that one could really understand on a going forward basis. Sure, they had projections that were normal projections that you would see, but when you took a step back and you looked at the out-of-network and the risks associated with the stability of the out-of-network profitability, that really impacted the Q of E and impacted the anticipated EBITDA going forward. So that was something that was very significant. The other deal that I wanted to talk about was a medical treatment center or recovery center deal that we did. And there we had the biggest challenge there, which was a little bit of a surprise because you don't really have an incredible amount of billing and coding kinds of issues that came up. But there we did. We actually did. We brought in an outside company to do a billing and coding audit, which was, at least it was anticipated at that time to be mostly confirmatory as opposed to exploratory, but it ended up being a big deal. That a lot of the codes that they were using were codes that they shouldn't have used, and it really exposed some significant weakness in terms of the revenues that they had. So those were two different deals that we had that just were the basic thesis of the deal, the expectations of the sellers in terms of multiples, the EBITDA that they thought that they were coming to market with ended up really not being the EBITDA that they actually had. So those were two One deal crashed and burned, not surprisingly, which was the first. The second one, got done, but at a much lower amount than that they had anticipated.
Yeah, I mean, Alan and I have had these conversations in the past. Like, when we launch a transaction, maybe 5 or 10 years ago, it was just take it out to market and let's just see how the market reacts and buyers react. Now, in this current environment, I think guys like you and I are spending way more time with clients, managing them, setting their expectations, telling them what could work, not work as it relates to coding, stuff like that, and not a network, and really sort of advising the client, like, there's a high probability that either you're not going to get a bidder here or there's just too much risk to execute. So
Exactly.
I know you and I are spending a lot more time just really working with clients.
People don't understand it, that when you go to a sale process, especially when you go to, you're not looking to sell to another small strategic or something like that, that you have a lot of work to do to get ready. And the common belief, and certainly in the less capital-intensive markets, certainly when you talk about inpatient psych, and those are bigger assets, bigger numbers, and you're going to spend the time to do that. But with the treatment centers, addiction centers, eating disorders, certainly ABA, a lot of that is, there's a level of disorganization that we see commonly there that really affects the process, and they would be very well advised. And we've done this, and you and I have talked to each other about this in the past. You have to take a really solid amount of time, get your act together from a documentation standpoint, get your billing and coding done, and assessed internally, or using an external source, but get it done before you go out to market, because that'll make it much more smooth, much more easy, and a lot less disruptive, and it'll make it much more efficient.
Yeah. Hey, Bede, are you seeing a lot of competition among your peers to invest in the behavioral space?
Yeah. Absolutely.
This is not just your unique thesis. Others I think about
it
it the
is
same
not
way.
just our unique thesis. I do just want to quickly say to Alan, yes, we love a clean process, and nothing dissuades us more as a buyer than just, when the box of receipts comes out and you're like, oh, that's your financials, that's a clear red light for us. But yeah, sorry, to your question, I think there are just so many different aspects of behavioral health. And we might have a thesis in one area, others might have a thesis in others. And then on top of that, it is very local. There are a few, larger national platforms, but sort of what is out there and what is attractive to people right now, whether it's a strategic add-on that's adding a series of states that your existing platform doesn't already have, or whether it's a extension of we're doing outpatient, but we think we could extend to outpatient adolescent, and we would do that more quickly and more efficiently through an acquisition rather than through building it ourselves. I think people the sponsor community is thinking more strategically about what investments they want to make right now. It's not just all behavioral is good. We should go into all behavioral, because people have also been burned, right? Like, while there are many who've been successful in the autism ABA space, there are quite a few large funds who have not done well there, and their thesis for expansion has not been rewarded. And so, this is sort of tracked along, and we as sponsors certainly look back at some of these precedent transactions that have occurred over the last few years, and we're continually reviewing and learning them from them, as are others.
Yep. Hey, Anton, you're one piece of that sort of behavioral care continuum. Do you guys ever debate, why don't we expand that continuum? Why don't we move up market, down market, follow the patient across?
We have that debate all the time, and I can go round and round and kind of talk myself into one thing, then talk myself into another thing. They all make sense from a perspective. We are hyper-focused right now in our strategy and just executing our de novo growth of our OTP clinics, and really just staying focused at core to what we do. We do, however, surround our clinics with housing. So even though it's not residential type reimbursable housing, it is housing that we provide to our clients, because we do know that it keeps the client more stable and engaged in treatment. So I definitely think that components like transportation, when you're talking about a Medicaid population, all need to be there, and those are all things that we do provide. We've debated getting into like 3.1, 3.5 residential type services. We're not there yet. Yeah. And I do think that the strategy does make sense. If you can step people down, the thing that's always kind of been a mystery to me is what's the true conversion there, and how successful are providers really from stepping people down from res to PHP to IOP. There's going to be leakage at all points of that funnel. And even though that idea sounds really good in theory, in practice, what does it really result in? And I don't know, to be honest.
What do you think, Chris? Have you cracked it?
Going up and downstream?
Yeah.
We're trying. I think there's not just in our organization, I'm sure other larger comprehensive organizations, you've got, the folks have done it the same way for 40 years internally, and you've got the thought leaders in the organization, and there's internal clash sometimes on where do we go from in 10 years, 20 years, 30 years. So I think what we have that is unique is that we have the network of acute care hospitals, medical acute care hospitals, and the enigma or the conundrum that wrapped in an enigma is figuring out how we can leverage those assets with our behavioral assets to find true medical behavioral integration. So I think we're ahead of the curve on that, but I don't think anyone's cracked the code yet.
Well, what we've also seen, Tony, one of the things that's interesting is that if you look at the other sectors of the healthcare spectrum, talking about inpatient hospital, let's just talk about home health, nursing home, an increasingly large percentage of that population is going to have some sort of a psychiatric or mental health diagnosis. Yep. Yep. And those providers are struggling, most of them. Certainly the post-acute care ones. The nursing homes are absolutely struggling with mental health issues that apply to a vast majority of their residents. And the home health folks are struggling with people who are trying to manage at home with increasing amounts of mental health. And what we're seeing some of the providers doing are trying to, I wouldn't say integrate, I think that's too strong of a word, but certainly align themselves with these providers to help them address issues within their care system, but having these kinds of collaborations where the mental health providers are able to assist those kinds of care sites and those kind of care deliveries to better serve their patients. And there's been a great deal of receptivity, I know, on the nursing home market and certainly in the home health market for that to kind of cross-pollination and cross-collaboration.
Hey, Bede, what about the new technology in behavioral, TMS, ketamine? Are you ready to embrace, adopt those as promises?
We have embraced them, and we are rolling them out. Not so much through promises, but through AthenaCare. I think the challenge with some of this new technology, new sort of deployments of drugs, is to be using it and get reimbursed on a commercial reimbursement side is tough, right? And there are a lot of hoops you have to jump through and specific criteria. Now, there are others who are out there in the market who are cash pay, sort of doing it for any condition, without failing multiple rounds of depressive therapy, things like that. And so it's creating the sort of two-tier, sort of doing it the right way and doing it the immediate cash pay way. And that's not to say that those providers are doing anything wrong, but it's a easier path to treatment. So I think the market has to still do a lot of learning. The referring providers need to do a lot of learning. But yeah, we're quite bullish about those technologies, and their demonstrated outcomes and ability to help patients is quite clear.
Yeah. Chris, what about you? What about a UHS? Are you embracing that new stuff yet?
I wouldn't call TMS new. I mean, I think that's been around for a while. That's largely a saturated market. There have been a number of physicians that have littered that across the country. We offer it as a service. Again, it's not a differentiator at this point. I think most people have that. I think some of these other treatments that you're talking about, whether it's ketamine, MDMA, and other treatment plans, I'm not sure that UHS is going to be the innovator around that, but I'm excited to see others do that and make it more commercially reasonable with the payers and the medical community so that we can embrace it.
Got it. Hey, Anton, Chris brought up earlier value-based. Is that part of the equation of your business, preparing to start taking risk eventually, or is that sort of the next buyer 5 or 10 years from now, at least as it relates to your business?
Yeah, I kind of echo the sentiments from the panel that we had yesterday on the M&A front regarding value-based. I mean, we've heard those words for so long, and everybody always talks about it. I think very few people are doing it, and the reason very few people are doing it is not because providers don't want to do it, it's because payers are not ready to do it. Any payer I approach, the vast majority of them have very antiquated systems. They are not ready to change those systems and really participate in a value-based arrangement. And when you approach them, they say, yeah, that sounds great, we want to do it, but we're not ready yet. And that's literally the same conversation we have with them year over year. So hopefully that changes, because it takes two to tango. The payer needs to be ready, and their systems need to be ready to take that on. As a provider, we are all about that. I want to put my money where my mouth is, and I want to, prove that, we deserve a better rate and that we can really take care of patients because of our model. So I think most providers that you speak to would be willing to do that. Certain payers that I'm talking to right now have almost an offering of value-based, and there's very few of them, but some have an offering. They can do full risk with you, and they advise you actually not to do that because they warn you that you're going to get hosed ahead of time, which is actually a good thing that they're giving you that warning. Then they have kind of half risk, and then they have no risk at all, but just a quality component, so you get a bonus if you hit that quality. So I thought that was, kind of a good offering to have that allows the provider to choose how they want to enter and dip their toe into value-based care before they dive head in. But as an industry, as healthcare in general, I think we have a really, really long way to go before this whole value-based thing becomes reality.
Until you're going to be able to track these patients all the way through the entire spectrum of providers, value-based care is it's kind of a fantasy, because you have no way of controlling. If somebody in one of Anton's facility has to go be hospitalized in one of the UHS facilities, Anton, I mean, they're very good friends, I know that. We can call them up, but they're not going to be able to track that patient on a real-time basis in order to track the spend in any kind of, and that's really the secret to value-based, is being able to, on a real-time basis, to get transparent information in terms of where the patient is, what the condition is, and can that patient be treated in a less intense environment. And that just, that degree of transparency among the different elements of the mental health spectrum just doesn't exist yet.
I would say, and this is something that applies across all of our portfolio assets, physician platforms, as well as our behavioral health, getting ready for value-based care is important. And everyone could do well to focus on reducing costs, delivering the most cost-efficient care as possible, and having clear data, right? Those are, at its core, sort of the two fundamentals of value-based care that do them now, do them later. They help you now. So why not get on those elements of value-based care today, as opposed to waiting for bundles and other value-based care payment mechanisms to come about in the future?
Hey, Chris, without you offending anyone in the audience, is there a particular subsector of behavioral that you would short today?
Yeah, all of my public competitors. Other than them, I think there's a lot of sectors, and I would say maybe like the traditional it's one of your other questions, like what deals am I following? I'm following kind of the life sciences, the refreshes, the embarks, but I'm also hesitant about that too, because they're really kind of the complement of what primary care is doing in the behavioral health world. Physician aggregation, therapist aggregation. Yeah. It is much easier to build an outpatient clinic than buy an outpatient clinic every day of the week. And so the valuations are often, not in alignment. And the difference with, I think, with primary care is that I feel like there's a stickiness to those providers. Behavioral health clinicians are hustlers. They work five or six different jobs. So, hard workers. And they know how to work the system into their advantage. And so just because you have a clinician as part of your network doesn't mean that clinician is yours. They could be working at 5 or 6 different places. So I think it's an industry that I'm excited about the growth, but at the same time, I think it'll be interesting to see at the end of the day if there's enough clinicians.
Yep. Just out of curiosity, what is UHS doing on that labor front? Are you recruiting overseas? Is it training? Are you sponsoring schools?
Yeah. I mean, we largely we're not in the traditional outpatient world, which is just a tremendous P times V in around revenue cycle. I think we are in it where it makes sense in some of our markets. But I think one of the things that we're doing in a unique sense is we have a program that's called Adventure RN, that a nurse or any clinician across the entire country could act as a travel nurse within the UHS network. If they want to work in Anchorage, Alaska, Miami, Florida, Boston, Massachusetts, or Chicago, Illinois, pick your poison. And so I think that it's an attractive program, and we have a lot to offer around that.
That's great. Anton, who would you short?
I don't know that I would short anybody. I'm biased, obviously, because I'm in the outpatient space, but I think there's always going to be a need for every aspect and every piece of the funnel there at some point. I'm not sure I'm so hot on all the massive telehealth platforms, so that, if I was to give an answer, it would be that. But there's always going to be a need for luxury residential out of network. There's a clientele for that. There's a need for inpatient, Medicaid residential. There's, every piece of the funnel, there's a need. And if I was running an inpatient business, I'd be more biased towards an inpatient business right now. So I think there's always going to be a need, and there's just so much demand out there. The thing that we have to do as an industry is really professionalize this industry, because there's still a lot of opportunity to get there.
Same short question?
Yeah. Like, which areas are you just like, we're not going to invest in?
It's, I'd agree with Anton. It's not that there's a specific subsector of behavioral health that we're like, no, that's just overblown or overdone. I agree with you generally on the telehealth platforms. It's difficult to differentiate oneself. There are some providers who are differentiating themselves, but that seems like a overvalued and difficult space. For the rest of the subsectors, I would say there are certainly certain regions or states or sort of subsectors that we would short. But again, this comes back to it's the local reimbursement, the situation with state, the ability, whether there's a CON in a given state or not, labor rates that are very specific to specific locations. Like, that's what leads us to step away from a process or to short a subsector. There are just some states or some regions within states it's more difficult to operate in. And if you're trying to develop a platform, almost regardless of what subsector within behavioral health, and you're in one of those difficult zones, it's fantastic if you can make a go of it, and maybe you can be more successful and be the one person that succeeds there, but that's a home run, not like a consistent double.
Yep.
Tony, I want to sort of share a cautionary tale about, you talked about a transaction before that you were involved in that was particularly noteworthy. One of the sectors in the mental health spectrum is IDD and group homes, which it's a very much needed sector. The community needs it badly, the patients need it badly. But there were a few companies that tried to aggressively move into the more unstable patients in an IDD environment. People with eating disorders, people with violent tendencies. And what they were finding was that the states were desperate, because almost all of these people were on Medicaid or some sort of state assistance, and they were desperate to find some place that will take these kids or young adults. And they were making a lot of money doing that. But the patient population was so inherently unstable, and where these people needed literally one-on-one supervision, and they were unable to do that in a group home environment, that ultimately the whole thesis came crashing down because the states could not tolerate what was going on inside these facilities in terms of the way the gaps in care, the violence between patients and things like that. So it's a cautionary tale because people were attracted by the incredible amount of profitability associated with that, where states were paying literally tens of thousands of dollars a month to take care of certain kinds of patients. But it was certainly a bridge too far in terms of that environment.
Hey, Alan, another theme I've heard at the conference this week was the word repurpose. Like, do you buy a skilled nursing repurposed to behavioral, office building repurposed to outpatient? Again, lessons learned. What are things that folks need to think about when they're repurposing?
So yeah, there were a number of people at this conference, and I'm not pointing fingers at anybody, who said, yes, I have a nursing home building that's failing, or I can't get filled up, and it's an older building, and I want to turn it into a drug detox center. So my first question typically is, okay, so what do you know about the drug detox business? And most people say, I don't know anything, but it can't possibly be that hard, can it? I said, well, you really need to sort of understand how to drive the car before you buy the car. So yes, there have been many people who have learned that business and have taken over repurposing older nursing homes and have done so in a very profitable and in a very qualitative way. But there have been others who have been nursing home folks who really don't know the business, who just tried to convert it over without doing the appropriate amount of homework and getting the appropriate amount of quality industry people that understand the business to run it in order for that to be a really positive and constructive conversion.
Yeah, got it. Hey, Chris, besides valuation, what else when you're negotiating an M&A transaction? What other key terms are key to you to make sure that that deal is successful day one and in the long term?
Yeah, I think there's, figuring out what key management you want to retain. You don't want the corporate cheerleaders to run who are really supportive of the staff and the business. I also think it's important to corral kind of liabilities and escrows, if you will. I've seen that as a seller and a buyer, and I think it's important to define those terms. What are debt-like items and what will continue into the business.
Yep. I know, Bede, I've been involved in some of your transactions, and I know what's important to you is like incentivizing that management team in the equity pool.
Yes. Yeah. Very much so. That's exactly what I was going to say. Aligning with management and then making sure that the incentives are right. We do a lot of founder solutions as well. And so for someone selling their company to us, making sure that, in some cases, that it is appropriate for them to just sort of cash out and move on. But in most cases, we want and expect the founder to continue and to make sure that those incentives are aligned over the course of our hold period while we continue to build out the management team and grow the asset.
Yep. Alan, what about from a lawyer perspective? What are the other key terms?
Well, certainly, as some of the key terms have to deal with what I would say indemnification obligations as it relates to quality of billing and coding issues. You want to have a very healthy amount of an indemnification with respect to that. You want to have and make sure that there's enough money in the deal to protect yourself to doing that. We have found, and I'd love to hear everybody else's perspective, is that in larger deals, what you try to do is try to get rep and warranty insurance. We have found it to be very, very difficult to get rep and warranty insurance. Once you have a mental health deal or behavioral health deal that's big enough for rep and warranty insurance, we have found that the rep and warranty insurers are very skittish about issuing rep and warranty insurance, especially as it relates to what I would call the revenue issues, billing and coding, things like that. They just have not gotten comfortable doing that. And so that is certainly a challenge, which then moves it back to the issue of making sure that you have the adequate protections in those deals with respect to indemnification and protection with respect to liabilities that come out there. The other issue that I would focus on, and this really came out of a busted process, was the compliance program of that company, where they had locations in, I think, 20 different states, probably had 50 discrete sites in 20 different states, but they had no centralized program of reporting incidents up to a central location and can track it. And it became very clear that they really didn't know what was going on a real-time basis. And that was the difficulty in dealing with that, is how do you put that into the deal? How do you quantify that? How do you establish an indemnification escrow for something like that? And that was a big challenge.
Yep. Bede, what about the financing market? Right, obviously challenging. Another piece of the challenge of any type of transaction over the last couple of months. Have you found credit markets to reopen?
Yeah, I mean, our experience has been that, and we tend to not use a lot of debt initially in a lot of our transactions. So for us, it hasn't really been that impactful. For many, the banks, private lenders, if you have an established relationship, if you're growing on sort of an established asset, there is additional borrowing capacity available. For new assets, new relationships, you need to be remarkable and really stand out from the pack. Otherwise, the markets are largely, I wouldn't say closed, but are very careful today.
Yep. Anton, how are your banking relationships? Do you think you have the liquidity that's required for either M&A or, again, your organic growth strategy?
Yeah, we luckily don't have a ton of debt on our balance sheet, so we've been lucky in that regard. Our sponsor has been pretty conservative in that standpoint, which has been great for us, because as interest rates go up, the amount of cash that goes out the door to service that debt can become a big problem for many companies. I'm not having any trouble with in those issues right now. But I agree with Bede that it's tough to find deals right now. There's not a lot of deals coming to market. People are waiting until credit markets return to normal and valuations can return to normal. If you don't need to sell right now, if you don't need the capital, you're probably not going to, and that's okay. And I think in a year or two, nobody knows what will happen, but that's my belief. In about a couple years, it will kind of reverse course.
I think the biggest impact is being felt on the exit from middle market private equity, not the entry point, right? There's typically add-on or even smaller platform transactions that we make. We are doing those largely with equity and without debt, sort of up front. It's the exits, you've reached 30 million EBITDA, 40 million EBITDA, right? And you're passing that on to a larger private equity firm or a strategic whose just their model is to layer significantly more debt on. Those transactions, I mean, as you must know, are having a lot more difficulty.
Yeah, for sure.
Yeah. Great. Well, thank you so much, gentlemen. We've got another 10 minutes, so if anyone out there have any questions or comments to our panelists, this may be the time.
I wasn't familiar with the phrase revenue warranty insurance.
Rep and warranty insurance? Sure. Rep and warranty, this is a relatively new phenomenon that in any kind of a stock deal or an asset deal, there are representations and warranties that are made by a seller to a buyer. There are fewer that are made from a buyer to a seller. And there's actually an insurance product that one can buy that ensures that if there's a breach of a representation warranty, that the buyer which acquires the policy has insurance coverage to do that. So that when you get that kind of coverage, the intensity of the negotiations of the representations and warranties are not nearly what they would be without the insurance, because you don't have that degree of protection. The problem with rep and warranty insurance is that it's very expensive. And unless you have a deal of a fairly substantial size, probably close to, I would say, high 8 figures, low 9 figures, it's really not that cost efficient, because the cost of those policies are hundreds of thousands of dollars, and they have very interesting and intricate underwriting requirements. But as I said, in this particular sector, we have found a degree of just unwillingness of the insurers to kind of embrace these kinds of transactions. Not that they won't, but there's definitely more reluctance on their part with respect to this particular sector than we have seen, for example, in home health or hospice or some of the other verticals that are out there.
Yeah.
Anyone else? Great. Thank you so much.
Thank you.
Thank you, guys.